My name is Scott Macmillan. I'm the Managing Director of Invictus Energy Ltd. Our asset consists of Special Grant 4571 located in the north of Zimbabwe. We are drilling the world-class Mukuyu prospect from August 2022, which is targeting 20 trillion cubic feet and 850 million barrels of condensate in 7 stacked targets.
Scott, good to see you. We had a great conversation with you back in April about it's technical analysis and due diligence, we called it. We really kind of got stuck into it. Appreciated you doing that with us. I want to talk to you about the market more broadly for energy, because it seems to be a very, very hot topic at the moment. But first, we better get an update from you. You put some information out a couple of weeks ago, or a few weeks ago. Can you tell us a little bit more about what you now know?
Sure. So following up from our discussion in April, we've had ERCE, who's an independent consultant, provide us with an updated prospective resource estimate for our Mukuyu prospect. So previously, based on the mobile data that we had reinterpreted and reprocessed, that was 8.2 trillion cubic feet and 247 million barrels of condensate. Subsequently, with the seismic data that we acquired at the end of last year over a much finer grid, which has given us a lot more detailed picture, that's been upgraded now to 20 trillion cubic feet and 845 million barrels of condensate. So roughly 4.3 billion barrels of oil equivalent, which is a world-class target and very, very enticing to chase onshore for a very, very modest cost.
Well, yeah. Well, it might be kind of going over a little bit of old ground in the sense that this is not like mining. You were talking about drilling 2 holes imminently. One, I know there's a rig at site at the moment for the first hole. But what's the work that happens above ground before you actually get the drills turning?
Look, it's a hugely involved process to get to the to start drilling. So it takes probably years worth of planning to get to that point. You've got long leads to secure, casing, wellheads. You've got to obviously contract a rig, and no oil and gas rigs that have been anywhere near Zimbabwe in the previous future. You've got to identify the prospect that you want to drill, the well trajectory that you want to drill, develop your drilling program, construct your well pad, and then the logistics to move in all of that oil field equipment is something to behold. This has been a truly international effort from our team. We've sourced equipment from virtually every continent on the planet, bar South America, to get lined up for this program.
Yeah, so logistics, absolutely. But even before that, I'm intrigued by the sort of updated prospective resource data that you put out. You did a lot of seismic work. So in terms of how you approach something like that and what you're looking for, and whether you're doing 2D, 3D seismic, I mean, how much time, money, etc., is involved in that?
Sure. So the basis of the seismic program that we shot last year was to go and collect infill data. To infill between the old mobile data that we had that was shot in 1990, and that was 15 to 20 kilometer line spacing. So a lot of gaps to be filled in between those existing lines. So we infilled that to about 1.7 kilometers. The technology of seismic acquisition has changed quite a lot since in the last 30 years since Mobil acquired their survey. So even though our surveys were sort of similar in terms of their length, the data density that we acquired from our survey was about 200 times greater than what Mobil acquired. So it allowed us to view the subsurface in far more detail. So we've been able to pick out new horizons and new targets within the Mukuyu prospect, even though it's this enormous feature, 200 square kilometers under closure, and we had coverage from that previous Mobil grid. Infilling it, though, has really changed our view of it and changed the prospectivity and the risk of it as well. So there were a few reasons behind what we needed to do to go and shoot that infill. 2D onshore is not, is relatively cost effective. We spent, I think for our 840 kilometer program, about $6 million acquiring that. The processing is about, typically for seismic is about 10% of that cost. And then, the interpretation in-house, roughly from when we started the seismic program in, I think second half of last year to drilling, we've moved pretty quickly. So often companies would take a little while longer to sit and interpret data. We've had the luxury of having that mobile data set that we've been able to work off and move pretty quickly and commit to drilling this enormous prospect. So,
but it's a really large land package, and you can blow a lot of money quite easily. So in terms of those sort of trapping rocks or those hosting rocks that you're looking for, what's the difference between the 2D work, which some people say is absolutely perfectly good enough for doing what you're doing, and others saying, well, actually, with a little bit more money and a little bit more certainty is given with 3D drilling. So what's the difference between the two?
Sure. So two-dimensional seismic as opposed to three-dimensional seismic. Obviously, 3D gives you a much greater picture. Onshore 3D is a lot more expensive to acquire. And I think probably the key difference here of us doing 2D first versus 3D is we're hunting big structural targets. So something that has robust closures, robust trapping mechanisms, and not anything subtle from a stratigraphic point of view that needs just a little pinch point that you don't quite have mapped in 3D. It might fall in between the spaces of the 2D lines to provide a failure mechanism and a leak point for that particular prospect. So, we're of the opinion if you're going into a frontier basin, you need to be, elephant hunting, which is what we're doing, and you need to drill those big structural prospects first. And that's how, historically big fields have been found, because they're not subtle. You can view them on 2D, and you don't need, very, very fine 3D coverage to identify them in the first place.
Right, but again, this is for a kind of a big audience of people and perhaps looking in, if not invested in oil and gas space before, because you want to attract new money. So people who may be used to mining, drilling, when you're sort of chasing metals or minerals, a lot cheaper. Can be, no less shallow, but it's typically a lot cheaper. I mean, the cost of the two holes that you're looking to do imminently is what?
So Mukuyu 1, the first well that we will be drilling in the program, and that goes to a depth of around 3,500 meters that we're drilling. That's approximately $16.5 million US dollars. The shallower basin margin well that we plan to drill following that is sort of sub 2,000 meters and roughly 10.5 million US.
Right.
So we're talking orders of magnitude difference compared to mineral exploration. So that's why you've got to do a lot of that seismic work first to identify the right prospects to drill and the right well trajectories to drill to make sure that you test those targets.
Right. So, I mean, given that means you've got to go hunting for your best target first, because no one wants a duster. But sometimes with mining, you can just sort of test the edges of the envelope, as it were, just trying to understand if your hypothesis here, because of market demands, you're going to need to hit it out of the gate, aren't you? So how do you go about that kind of targeting regime, whether you're chasing multiple layers or let's say like a big hit out of the gate? So
fortunately for us, we inherited a fantastic data set that Mobil left behind when they explored the basin in the 1990s. And they did identify this big Mozambique anticline. So an anticline is a big dome structure, the structural targets that we were referring to earlier. Enormous feature. It's 200 square kilometers under closure, the largest undrilled structure in onshore Africa. But the reason that Mobil left it alone in the early 90s was because there was no market for gas at that stage. And they thought that the basin, the petroleum system in the Cabora Bassa basin was more gas prone as opposed to oil prone. And so, there'd been onshore discoveries in Mozambique that still hadn't been monetized by that stage. And so they saw very little point in trying to find more gas with and continue on to the exploration drilling. So we took that Mobil data set, and when we took it over, we just had the paper sections to work over, and you can still see that anticlines stick out on those paper sections. But we were lucky that we also inherited the field tapes. We reprocessed those, cleaned that data up, identified that big Mukuyu structure, as well as these interesting structural features along the basin margin that we've, in the second play that we're planning to test, which look more akin to your East African rift system and these sort of smaller three-way closures up against the basin bounding fault, a lot like you've had in the Lokichar Basin, where companies like Tullow and Africa Oil have been very successful. And so using that Mobil data, we were able to refine the infill seismic program that we went and shot last year to make sure that we're chasing the right targets and getting data over these the basin margins were leads at that point, so not really mature enough to be prospects, and then also infill those lines in between the Mukuyu prospect to make sure that we could develop the right well trajectory, because we've got stack targets and we want to intersect those in the right locations to test the Mukuyu prospect in the best possible way and give ourselves the best chance of success.
Right. So, and how do you go about this in terms of, again, because you got to talk to the market here, and they've got to see that you guys are, like say, hitting it first time. First drill is going after Mukuyu. Second drill is looking for what, a different target, a new discovery, or are you doing something to enhance the first drill?
No. So the reason that we wanted to drill 2 wells is to test 2 independent play types.
But why is that safe? Why is that good? Because do you know? I'm trying to work out to the extent of what you know after the first drill site. Like, say you hit hydrocarbons immediately. How do you know the extent of that, the scale of that? When
you're exploring a frontier basin and there's no well data to calibrate any of your seismic, and that first well is going to tell us a lot of information whether we're successful or not, because we're going to have the data from the well to really help pin down what our seismic data is actually telling us. If we are successful, we've obviously got very, very good problems, champagne problems, I like to call them. And that will allow us to then look at the play fairway further away from us in the basin and identify the similarities of in the same play trend of prospects that will then follow up from where Mukuyu is. So we've got two different play types, and a play type consists of your petroleum system elements: source rock, reservoir, seal, and trap. So some of them are similar, but others are different, and the trap for these 2 different plays is different, and there's probably an additional source rock element in the basin margin play as well. So drilling 2 wells and testing the same type of play, if the first one is unsuccessful, then, and we think we've drilled the best one, then it's very hard to justify following up the same play type with a second well. But testing another play type, that even if the first one fails, we still can have some success in a different play type, which will then, if either of them are successful, will unlock running room for prospects that belong to that play.
Right, and do you have this sort of opportunity? I mean, you're going down quite a way. So, do you have an opportunity of like hitting, different horizons on your way down to the larger target? And what does that information tell you? Yeah,
so we're very fortunate in this basin where we've got stacked prospectivity. So a number of horizons that we'll drill through. So in Mukuyu, we've got 7 stacked targets to test, and success at any one of those will be, from the sort of volumes that we're talking, in any one of those horizons will be transformational. And the same in the basin margin play. And and we're not going to get into probabilistic aggregation here, but the more targets you have, the more chances of success that you have, and the greater of your overall chance of success in at least one of those horizons through having multiple prospects. Probably the best analogy to give would be rolling a dice, where if you've got one chance to, say you want to try and roll the number 6, you've got 1 in 6 chance of rolling a 6. If you've got 7 targets like we do in Mukuyu 1, and you just need to roll 1 6 out of those seven targets, your odds of success are much, much greater. So that's why we've selected these prospects to go and drill those stacked targets to try and test as many horizons as possible to give us the maximum chance of success and unlock this basin. Because if the petroleum system does work, it doesn't work in isolation. If you look at the North Sea, all of those discovery trends, you don't just find one field in isolation. You find a lot of them in the basin.
Right. Well, let's try and help me and people watching this try and understand the scale of it, because the numbers are big. We're talking about, I think, sort of 90 CF last time we talked, and a bunch of condensate as well. And I think you've got a contract in place with Sable. Is that right, for 20 years, or is that? yet to be signed off?
So the gas sale MOU that we have in place with Sable Chemicals, a fertilizer manufacturer, is for 20 years. That obviously is predicated on a commercial discovery.
Right.
So that's around 510 billion cubic feet, so 500 billion cubic feet.
What's that worth
over 20 years?
What's that worth in dollars? Just give me a sense of quantum.
Look, the pricing is confidential under our contract, but to indicate, we'll just use some numbers for ease. So if you take South African domestic gas prices at the moment of what's being used there at $10 an MCF, 510 BCF, is worth around about $5 billion over the course of 20 years.
Right. Okay. So you have I appreciate it's all confidential, but potentially that's a big contract, but that's just one bit of what you hope to find with your land package there. You've raised some money, $12 million or so back in May. If these two holes hit, what's your view of your ability to actually raise money in this market? Because most people are kind of looking at this moment in time now. Okay, it's risk off. People are hoarding their cash. It doesn't look like people are too confident about what's happening in the marketplace. But there's an energy crisis too. So how do you feel about this environment?
The environment for Invictus, in particular, I think we've enjoyed some tremendous support from our shareholders and institutional investors. And I think what the appeal of Invictus is the size of the prize and the potential of what we're chasing here from an exploration point of view. To have something like this, 20 TCF and 845 million barrels of condensate in just the one prospect and have an 80% equity holding it at the moment is very, very rare to find. So from an exploration point of view, typically that's been the hardest part to fund traditionally for juniors because of the risk associated with it. But I think the risk reward balance for Invictus is one of these, very, very rare events. So if we do discover something and we can unlock the full scale of it, and if it's a multi-TCF discovery, we're looking at a long development period. We've got rich markets, not only in Zimbabwe, but in the rest of the region with the Southern Africa power pool, providing gas-fired power to not only Zimbabwe, but South Africa as well, which is experiencing, economic growth being constrained by the lack of power. So we've got the ability to put gas to wire across the region into a huge pool and monetize it relatively quickly and inexpensively. We're not having to build pipelines everywhere. It's it's quite modest from an infrastructure point of view, and weaning South Africa off coal-fired power as well is a side benefit as well from a carbon emission standpoint. So, I think if we are successful, developing this project and raising money for it is not going to be too much of a concern on our end. I think we're going to have we've had preliminary discussions with some of the multilateral institutions there who are looking at this very closely, because this is one of the potential energy silver bullets for the region if we're successful.
It's interesting. Obviously, you referred earlier to Mobil saying, well, actually, we don't need to develop Zimbabwe because we've got all of this onshore, offshore gas over at Mozambique. But that was, a while ago, nearly 3 decades ago. Those fields are maturing now, or maybe there will be additional investment in it, but it has not been a sort of investment environment for certainly the last 10 years for oil and gas in any meaningful way. Do you expect Mozambique to come back online? Do you think the investment will be put into Mozambique, and how will that affect your ability to, one, raise capital, and two, ability to sell your product into market?
Yeah. So from the Mozambique perspective, Panda and Tamana, the fields that supply now 100% of South Africa's gas consumption, are very mature. They've been on stream since 2002, and they come off plateau at the end of this year. And South Africa has become addicted to cheap gas, and gas that is a lot like Europe did. But now with those fields maturing, there's a real supply crisis brewing in South Africa, and the energy the USAID, who run a group called Energy Africa, predict that there will be a 1 billion cubic feet per day shortfall in South Africa by 2030, which is enormous. It's the same amount that's consumed in the entire east coast of Australia, from so that's manufacturing, residential, etc. And for around those fields, there's been a lot of drilling over the last sort of 10 years, looking for additional supply to bring into the gas market in South Africa, but so far it's been unsuccessful. So they're really at a crossroads now, where they're looking at LNG imports for South Africa. And during COVID, that's when gas prices and LNG prices fell to $3. That looked like a sound strategy, similar kind of pricing to gas that they're sourcing from onshore Mozambique. But now, with LNG prices the way they are, South Africa is going to be competing against Europe and Asia for LNG, which means that you're talking of prices north of $20 now, which is unaffordable in South Africa. So I think a solution like ours, where we can provide long-term take-or-pay contracts that will supply the South African domestic market. We're not looking to export. We think there's plenty of opportunity in Southern Africa. I think is something that is desperately needed and will be really welcomed in the region.
Right, and the whole kind of Russia-Ukraine situation, Russia, Nord Stream 1 and 2 into Europe. I mean, it's a very hot topic at the moment, because prices across Europe have risen significantly to the point where people's disposable income, discretionary spend has been affected greatly, because they're focused on heating their houses or putting fuel in their cars to get to work, etc. What do you think the knock-on effect is for Africa, if any?
Look, the knock-on effect for Africa, I think, potentially could be really positive out of the situation. And that really is due to the fact that there are a lot of undeveloped gas discoveries, particularly offshore. We've still got the fields in northern Mozambique to come online. Look, a lot of those volumes are contracted out already for the first 10 years. But certainly in West Africa, there's a huge amount of undeveloped gas. And the reason that it's been undeveloped is because the prices have been too low and the market's too narrow to really justify an offshore development and then LNG trades. So I think Africa can really be a winner now for places like Europe looking for long-term supply alternatives from Russia. And the development of that LNG industry will then also bring in domestic gas, because often there's a compulsory domestic market obligation that come along with LNG development. So those developments will then put in gas into those local economies, whether it's Angola, whether it's Senegal, and really help the industrialization of those economies as well, and the electrification of them, because Africa is desperately short of power. 640 million Africans don't have access to electricity, and that's a situation that's got to change if the continent's going to realize its potential.
Right. Okay. And talk to me about Zimbabwe, because obviously it's had a sort of checkered past in terms of international foreign direct investment perception. Anyway, what's the new government doing? Is it behaving?
Look, it has been a change from the previous regime, and particularly in the latter half of the Mugabe era, where there was some very, very draconian investment policies that were brought in, that really not prohibited foreign investment, but made it virtually impossible to do so. So the new government has brought in investor-friendly reforms, trying to attract foreign investment back into the country, and that's beginning to pay dividends. We've seen a lot of new investment come in from existing companies, the platinum miners, for example, Amplats, Anglo American. We've seen a new stainless steel plant being manufactured that's going to require a lot of electricity and a lot of gas to get up and running. We've seen lithium transactions now take place, where we've had an ASX company over here, Prospective Resources, who developed a lithium project and have successfully sold it after quite a competitive bidding process. So I think the doors have been opened again, and people have realised that it is possible to do investment in Zimbabwe.
Right. Okay. And I just kind of want to finish off in terms of helping investors understand how companies like yours progress through those different sort of stepping stones to greatness. You guys are all kind of blue chip, Woodside, etc. If these two drills hit what you think they're going to hit, how do you go through the fundraising process? And at what point do you need to bring in significant balance sheet to help, or other types of money? Because you're not going to keep diluting shareholders in perpetuity. So how does it work? Look,
I think the strategy from a post-discovery scenario would be to bring in a development partner for that. And for the size of the potential that we're talking about, if it's anywhere near that, because of the upside, we'll be able to get a significant portion of that funding paid for through a partner that comes into the project. Because again, the amount of equity that we currently have, and what can be funded with the sell down on our part will be. I think the balance sheet problems won't be an issue. We've got a lot of the other multilateral institutions, Africa Development Bank, Africa Finance Corporation, because of the integrated nature of this project with electricity for the region, with fertilizer production for the region, we'll be able to access, very concessional, type loans to get this development off the ground, because it is so strategic to the development of the region. So, I think in that case we'll be okay. And there's always, probably the Harbour Resources scenario, where something like this that is so strategic and so large, will attract some M&A attention as well.
Right. Okay. Let's finish off with so timings. Obviously, drill rig on site at the moment. You're going to be drilling in August, you say. How quickly does that information then feed back into the market in terms of the whatever you discover?
Sure. So Exalo's rig 202 is on site at the moment and rigging up. They've got a little bit of maintenance work to do before we commence the drilling. So at this stage, we're looking at from around about mid-August or so, depending on how long their maintenance program takes. Mukuyu 1, we think is a 45 to 60 day well, based on the targets that we're drilling. Probably a little bit longer in a success case, because we will have to do a lot of logging and fluid sampling and core cutting as well, sidewall cores. And that will, because we've got 7 stacked targets, we've got news flow all the way through the well. So it's not just one target that's typically found towards the deeper ends or the deeper sections of your drilling program. We've got our first target, the 200 horizon, that's, roughly 850 meters beneath the surface. So that'll come up, probably in the first 2 to 3 weeks of drilling.
Okay.
So we'll be drilling, once the Mukuyu well is completed, then assess those results, and then onto the base and margin well.
Okay, fantastic. Okay, well, something to look forward to. Best of luck with that. Appreciate you coming on today and letting us know what's going on. Exciting times.
Matt, thanks for having me.